Good afternoon, everyone, and welcome to the Stock Market Today video. It's Justin Nielsen here, along with Ed Carson. It is Tuesday, January 10th, 2023. I'm still getting the year right and the month right, I guess. Yeah, we're going to check in on the market today and see how things ended up. Ed has chosen a few stocks for us to go over, including Medpace, ticker symbol MEDP, Elf Beauty, which is ELF, and also Super Microcomputer, SMCI. So before we get into that, let's take a look at how the indexes fared. The S&P 500 was up 0.7%. The NASDAQ Composite up a full 1%, really kind of getting some strength into the close there. The Dow Jones Industrial Average about a little bit over 0.5%, and the Russell 2000 rounding it out with a gain of 1.5%. That put the Russell 2000 and S&P 500 both back above their 50-day moving average lines. Ed, give us your take.
Yeah, I mean, it was looking pretty indecisive for much of the session that there was not much going on. But after Monday's downside reversal, definitely had some more positive action. It was one thing that would keep in mind is that the market, still around these moving averages. It's not decisively above. It's nice that the S&P is above its 50-day line for the first time in several weeks. You definitely want to be on that side of the tracks. But there's still a lot of resistance levels. And of course, we have Thursday's CPI report, which could make all these recent moves just go away in a flash, or have us take off on a positive note too.
Yeah, and as you mentioned, before we jumped on the show, I mean, we got above the 50-day moving average line before, but it could just be a whisper that knocks it right back down below it. I mean, we saw that yesterday.
Yeah. Yeah, just a whisper. And obviously the CPI report might be a lot more than that. So on the upside, a lot of these indexes are coming up to moving averages. If you could get, back above the 200-day line and, the NASDAQ out above the 50-day, things would start looking a lot brighter in that regard. But I also say, and we'll go into it, but leading stocks were definitely in flux too. I mean, obviously, with the market up, more were rallying today, but we still had downside reversals. We had downside reversals yesterday. It's still very difficult to trade, even more than the indexes would suggest. Because if you look at the index, the last couple of weeks, we're sort of trending higher, but it's like, man, a lot of stocks flash buy signals, and then the next day or maybe the next hour start reversing lower. So still very difficult to navigate.
Yeah. So the S&P 500 back above the 50-day moving average line. Let's take a look at the NASDAQ Composite. The NASDAQ, of course, it's a very tech-heavy index and has been the laggard. But on Friday, it was showing more strength than any of the other indexes, and was besides the Russell 2000, was also one of the leading indexes today with a gain of over 1%.
So it's a little bit more distance above the 21-day line. Obviously, getting above Monday's high and the 50-day line would be really nice. I mean, you can see that there's plenty of resistance levels that you could come up with. There's no shortage of that with the NASDAQ, but lagging, but is making some progress.
And over at the Dow Jones Industrial Average, that one, despite the reversal yesterday, still remained above its 50-day moving average line, its 21-day moving average line. This has been the leading index really since that October bottom, after after one of the CPI reports came in. What's your take? Is industrials, is the slower movers still the place to be, or is there some sector rotation?
I mean, that's the thing you always have to watch out. And if we really take off, will growth start to come back? Who knows? I mean, honestly, a lot of sectors like health insurance look so strong, and then then in 2023 have really slumped. So it does seem like industrials are still a place to be. We'll see how things go. Right now, still looking strong. They held up better they rallied more than growth stocks. They held up better than growth stocks, and still well positioned.
Now, let's go ahead and round out the discussion with a look at IWM, which is the iShares Russell 2000 ETF. And what we see here, I mean, look at that 50-day moving average line and 200-day moving average line, really narrowing the gap between the two. This one also did close above that 50-day moving average line today, as you mentioned, above the 180 level. What does the small caps market kind of tell you when this is acting strong relative to the big caps, or even just by itself showing strength?
I mean, the small caps tend to be more volatile, so it's not a surprise to see on any given day that they're going to be the big winner or loser. I mean, but the trend has been a little better. I mean, it's a little better certainly the S&P or Nasdaq, maybe not the Dow. So it's a positive. When you strip out some of the things like the big health insurers, when you strip out Tesla, when you strip out Apple, there is a little more strength. It's not like overwhelming. It's not like you look at the Russell and go, "Wow, look at that power," but it's a little bit more positive in that regard.
Yeah, and we wouldn't be complete without taking a look at the 10-year Treasury yield. We use 0TNX for MarketSmith to kind of have that come up. And again, remember that the 10-year yield is, of course, in inverse proportion to what is happening in the bonds. When there's bond buying, you'll see that yield go down, and when there's bond selling, you'll see that yield go up. But today looked like a strong bounce, and I thought it was supposed to be that when the yield was up, the markets were down. What happened?
Yeah, I mean, that's broken up a little bit in the last month or two. I'm not saying that, this yield rise eventually seemed to pressure stocks, but part of the reason why the yield has been coming down, especially the 10-year yield, is because of recession fears. And the stock market doesn't want that. I mean, stock market wants the Fed to stop raising rates, but they also don't want a recession. And so, a rising yield isn't necessarily death to stock prices on any given day right now.
Right. And the chips, this has been an area, I mean, it's a little fragmented. You have some stocks in this chip sector that are looking very strong, well above their 50-day lines and their 200-day lines. Others, not so much. But the VanEck Semiconductor ETF is a pretty good representation of the overall industry. That looks like it's coming up to its 200-day line, on the verge of potentially breaking up above it, or is this as much as we're going to see out of it, and this is where we're going to hit resistance and fall lower?
And the answer is yes. I mean,
Right.
yeah, it did technically get a close above the 200-day line. It'd be really nice to get, yeah, this was the peak of the market and the chips came down. It is positive to see that. It's a positive sign that, if the market's going to rally, chips are in everything, and chips are just a huge share of the market anyway. So this is doing reasonably well. Yeah, there's some high flyers in there. There's also some big chip equipment makers that are bouncing back. And I'm just going to bring up very briefly TSM. They reported sales today for December. They're going to report, on Thursday, they're going to report their earnings. So we're going to get not only their earnings, and they make chips for Apple and Qualcomm and NVIDIA. So their guidance will be a little bit of instructive about how things are. Their capital spending plans will be interesting for some of these chip gear makers. So I think that'll be a big report. You could almost argue this is a bottoming base. Yeah, it's formed below the 200-day line, but if it broke out, it would be above the 200-day line. So, that looks like an important report. Same day as the CPI, so there's a lot of cross currents. But Thursday is a very important day for chips.
Yeah, and it should be mentioned that in that SMH ETF, Taiwan Semiconductor is one of the largest holdings. It's over a 10% weight in there. And you mentioned earnings. I mean, we've got earnings season coming. So beyond the CPI report, that's just in time for earnings season and that whole fun quarterly job there.
Yeah, and with the economy slowing, there's rising costs. There's all these things going on. The earnings, we'll see how the earnings outlook. It's not just the earnings, but the guidance will be critical. See how that goes, because stocks that may look cheap may not look so cheap if they cut their guidance 30% for 2023.
Right. And of course, banks are going to be starting things off with a lot of those banks having their earnings this week. So that'll be kind of kicking things off. Before we finish off with ETFs and the indexes, let's go ahead and take a look at two more. We talked a little bit about big caps, small caps, but what about right in between with the mid caps? And MDY is one of the ETFs that tracks the mid cap market. This one is actually looking a little bit stronger, having already crossed both the 50-day and 200-day moving average line ahead of many of the other indexes. So where are the mid caps falling?
Yeah, this is nice. This is not quite as strong. It's about almost as strong as the Dow. I mean, it didn't hold as well maybe in here, but so you got the Dow looking good. You have the mid caps looking better. The S&P and Russell are trying to get there. So there are some positive signs. Again, we just need that momentum to continue. It's like we're there, but haven't quite really kicked in to make you feel more comfortable in the consistency that make you feel like, okay, I can start building up exposure.
And then finally, let's take a look at RSP, which is the equal weighted S&P 500. The normally the indexes like the S&P 500 and Nasdaq are market cap weighted, and so you get a lot of influence from Apple and Microsoft and some of the big mega cap companies. But when you do an equal weight, it kind of treats those 500 companies all the same in terms of their weighting. So what is kind of happening here? Why the divergence?
Well, back here, I think the divergence isn't so much the last few days. It's just that they was
Hmm.
in a better position. It's just that
Yeah.
this is what's happening. When Apple and Tesla and Microsoft were all tumbling in this area, the RSP was sort of trending higher. So when Friday came along, it was just in a better position to be moving higher. Today, pretty much in line with the S&P. But yeah, this is looking pretty strong. You strip out some of those big gigantic laggards, and the market looks a little better.
Yeah, if you start the race with a head start, you don't have to be going faster in order to win. You just have to go the
Yeah,
same pace, right?
that's right.
Okay, let's take a look. Speaking of pace, let's take a look at Medpace, MEDP. This is something that Leaderboard had on its radar, all the way back in October. Put on a position, a half position, as an idea back on December 28th, and now added to that position today. Looks like we were crossing a downtrend, and I actually have shares of this myself. But what's your take on this one, Ed?
Yeah, this looks great. We tried, Medpace tried to move out on this day, and it did, but then immediately sort of came back. And some stocks that have done this have faltered and then they've fallen apart. And this one did not, and it's just hard to know. It didn't look so good. It didn't look so good in this area. It was like, oh boy, this is starting to really falter. But this came out strong volume, really strong volume, and that especially compared to the last few weeks, breaking above the 50-day line, breaking above this short-term high, the December 29th high. So this could be a new early entry. The always question is, will this follow up? And that's a question you could say just about any stock that's moved up. Some keep moving up, some
Right.
reverse right away, some move up and then reverse and round trip a nice solid gain. So, at this point, it's starting to get up there versus the 50-day line in this kind of market, especially with the CPI coming up. But I think this was really nice action.
And I mistakenly said that it was December 28th. That was sticking in my head because that was the market low, but it was actually December 21st that Leaderboard put that position on. So
That
they
made it a
had a
lot
little bit of
easier there,
cushion,
that's for sure.
right?
Yeah.
Exactly. Had a little bit of a cushion, was able to withstand that little pain below the 50-day moving average line, and now that with the action today, that was a nice add to the position, making it a 3/4 position. Let's go ahead and take a look at something that wasn't so great. Elf Beauty, another great looking setup. This is one that I think a lot of us were watching. I personally had a position put on a couple days ago. I got rid of it yesterday because it just wasn't acting the way I thought it would. What's your take on this one, and what happened today?
I do not know. I did not see any news on this. And last Friday, it had almost a perfect breakout. Strong volume. The base was really nice. It was close to moving indexes, so you could easily get into this stock. It wasn't too extended even at the close. So this looked really good. Among all the breakouts, this would probably look the best that I remember because of that volume when a lot of them did not have it. Then Monday we reversed lower, and that was not a good sign. And so, yeah, that you definitely could have gotten out there or wanted to lighten your position. And those who didn't, it was really painful here because plunging through the 21-day, plunging through the 50, closing at lows. The market's closing at highs, and ELF is closing at lows, undercutting all this. So all this work, all this tight action. And again, that's just what makes it so difficult. This looked better than just about any stock, and then really in just a matter of a day or so, just all fell apart. And the volume was very high, and the volume was high on Friday, but the last 2 days have been even worse. So,
Right.
this was almost like a cautionary tale. It's like when you think about if you get excited about this market, if it's still going in the sideways action, maybe just call up this chart. Not that it's like, oh, not again, maybe things will work out, but you just have to know that yes, things may look good right now, but this has been a market where the market is volatile, sectors are volatile, and individual stocks are all volatile. It's been such a difficult market.
Yeah. And Elf, I mean, yesterday it was for a good portion of the day looking stronger than a lot of things because when the reversals were starting to happen, this was holding up a little bit better than a lot of things until the end. And then, it really came down sharply. And you can see at the lows of today around 52, that's right where it was getting support at the 50-day moving average line. So it seemed like
Yeah.
it jumped back up and was getting support at the 50-day line, only to retest those lows and eventually undercut them for a break below that 50-day moving average line by the end.
Yeah. Really
Okay,
ugly.
let's go ahead and take a look at another one that just didn't work out great. SMCI. This is one that we tried on Swing Trader, and yesterday's action was enough to knock us out of this stock. We were using the day's low after we put it on as our exit, and it did undercut that yesterday. Closed even lower, although it was up for the day. It still closed, really at the bottom of its range, gave up a lot of ground, and then the destruction just continued today with a gap down.
Yeah. There was a short seller report, maybe news of that short seller report was leaking yesterday. Who knows? The market reversing was enough. This is a volatile stock. I mean, that's the thing. That's why it's had some really big moves. This was probably one of the handful best growth stocks of 2022. Really made some nice moves, had really strong earnings. So this was really disappointing. And yeah, you have to be nimble in this market. And you guys at Swing Trader have been. This was looking good, flashing an early entry, and then reversed really hard. Today, I mean, you can argue, oh, okay, well, it found support right at the top of the old base. But if you're down 15%, and easily could have been if from 87, 88, you could easily be down 10%, 15%. You have to be getting out of that position. Yeah. So just again, really disappointing. This one looks so strong, had held support, and then things did not work out. And it's just until that really clears up, I think keeping exposure light, making new positions low, and letting the market rally draw you in gradually, if it's working. And right now it has not been working so well. So it's like gradually, then pull back. Right. So it's not been a gradual increase in exposure. It should still be pretty light.
And as you mentioned, I mean, yesterday, the action, the reversal certainly could have been blamed on the market. We were seeing a lot of reversals in the market yesterday, but there's so many times where we kind of see this action, like with Elf Beauty or what have you, where you don't know the reason behind the negative action, but sometimes that reason comes out a few days later.
Yeah, and yeah, we always talk about you buy in the fundamentals and technicals, but you sell primarily on the technicals. Yeah, the news comes out later, whether it's surprise news or it's just down the road you realize, oh, earnings are starting to slow. It wasn't in the actual earnings yet, but the growth is, did down the road come down and start slowing. So yeah, selling on the news is the chart. The chart is the news in many ways.
Right.
And that's what happened here for sure.
Well, thank you so much for that analysis and bringing up kind of the good, the bad, and the ugly in this market. And that'll do it for us today. As a reminder, we'll be back on the IBD Live show tomorrow. A lot of us will be joining. We had David Ryan, three-time U.S. investing champion, on today, and he was going through some of his trades of 2022, doing a little post-analysis. I think a lot of people really appreciated that he was sharing mistakes that he made and lessons that he's still trying to ingrain in himself as a very experienced investor. So something that I think we all learned something from. So if you haven't checked that show out, you can always take a look at investors.com/IBD Live, where we start 10 minutes before the open every morning and go well within an hour and a half of the market trading session to kind of give that real-time analysis. And of course, we'll also be back here on the Stock Market Today video. I think Ali and Ken are scheduled to be hosting tomorrow. So hope you join us for that. And thank you very, very much for watching us today. We'll see you tomorrow. Bye-bye now.